What's going on, guys? My name is Arjun and welcome back to my channel. In my previous video about options, I talked to you guys about what are options, what are the risks associated with options, and I briefly mentioned how some investors use them as part of their portfolio. Today I want to delve a little bit deeper into how investors use options as part of their portfolio, as well as show you a little bit more about how to read an options chart. I'll put a link to the previous video in the description. In the previous video, I mentioned 3 ways in which options are used as part of an overall portfolio. The first was to speculate on the overall direction that a stock may take. The second was to generate income. The third was to protect or hedge somebody's investments. So now, let's go a little bit further into this. Let me show you what the main advantages of using a call option versus just buying a stock. So let's say we had a stock at $100 per share and you wanted to buy 100 shares of that stock. Your cost would be $10,000, 100 times 100. If you wanted to buy one contract of a call option, and let's say for this discussion, the premium was $2 per share, your cost would be the premium times 100 shares, or $200. Now let's say the stock were to go up to $110 per share. In the case where you bought the shares, your 100 shares would return $10 times 100, $1,000, or a return of 10%. In the case of buying one contract, your premium is now $10 per share, and your return would be 10 minus 2, or 8, times 100, which is $800. This is a return of 400%. The main advantage to using an option is that you gain leverage on your money. But the biggest drawback to using an option is that options have an expiration date, which means that the option could become worthless before that 10% move in the stock happens. The first way in which people use options: speculating on the general direction of a stock. Will it go up or will it go down? So I'm going to show you an example now where we'll use the stock of Apple. You're going to buy a call option, which means you expect the stock to go up. From this chart I'll show you, as you can see, you buy a call option, strike price is $136, expiration date of February 19th, 2021. The stock is currently trading at $136.70. So your cost to buy one contract is $300, or the $3 premium that's there. Your cost to buy 100 shares is $13,670. So now in this diagram, you can see that your break-even price is $136, or the strike price, plus the $3 premium, or $139. Anything above $139 is all profit. And when you buy a call option, your profit potential is unlimited. The most money you could lose is the $3. Let's talk about the pros and cons of this situation. This allows you to leverage your money because there's a smaller initial investment. You could use the call option to buy the stock down the line. Some of the cons of this is that the stock may not move within your time period. The stock may stay at the same price, your option becomes worthless. And in the case of Apple, you don't own the stock, so if Apple were to distribute a dividend, you wouldn't be entitled to receive that. So now let's take a look at buying a put option, where you expect the stock to go down. Again, we're going to use Apple, a strike price of $136 and the same expiration date, February 19th, 2021. Your cost to buy one contract is $209, or 100 times $2.09, which is the premium. Your cost to short 100 shares would be $13,670. Check out my previous video on short selling to learn more about the risks of it. In this case, the most money you could lose is the $2.09 you spent as a premium. And your break-even price is $136, the strike price, minus $2.09 for a price of $133.91. Your max gain in this situation would be if the stock went to zero, or $133.91. Some of the pros in this situation: it's safer than the traditional short selling because your loss is limited to the premium that you put in. Whereas traditional short selling, the cons of this method, the stock may not move before the expiration date. The option becomes worthless at the expiration date even if the stock is just barely above the strike price. The second way you'll see investors use options is to generate income. This is done through selling calls and puts. Now note, there can be a higher risk in selling calls and puts, but we'll get into that. So first, let's talk about selling a put option. You expect the stock to go up. Again, we're going to take a look at the same option, 136 strike, expiration date February 19th. The premium is $2.09. So in this case, you're going to get $2.09 up front for taking this position. Your break-even price, 133 and 91 cents. Your max loss in this situation would be 133 and 91 cents. It's important to know that you keep the premium as long as the stock is above the strike price. As long as Apple stays above $136 per share, you will keep the premium that you receive. However, if the stock falls below the strike price, you will likely have to buy the shares of Apple. As far as the pros and cons of this method, let's say you wanted to buy the stock of Apple. You can use a put to generate the income, and if the stock comes down in price, you would also get to buy the stock. So in essence, you'd be buying the stock for a slightly lower price because you got the premium, and you keep that premium regardless of having to buy the stock. You also benefit in this situation if there's no movement in the stock, as long as it's above the strike price. The biggest con here is that you may be forced to buy the stock, which could require a lot of money. So now let's talk about selling a call option. Again, we'll talk about the same strike price, 136, February 19th, 2021 expiration. You expect the stock to go down in this situation. So your max gain here is $3, regardless of how far below 136 Apple's stock drops. That $3 premium plus the 136 gives you a break-even price of 139. But it's important to note here that your max loss is unlimited. So you keep the premium if the stock is below the strike price. A naked call is selling a call without owning the underlying stock, which in this case is Apple. Selling what's known as a naked call is extremely dangerous, and you have to be very cautious when doing so. This is very similar to short selling, where your loss is unlimited, where the stock price keeps moving up, but you would have to buy the stock at the higher price and sell it at the lower strike price. The biggest pro of this method is that this could generate some income in a down market. In my opinion, the cons of a naked call far outweigh the pro. You have an unlimited loss when it's done as a naked call, and timing is very difficult. However, there is a better way, and that's known as a covered call, where you own the stock position already. So in the situation of a covered call, your loss is limited by the fact that you already own the stock. Let's say you owned Apple at $100 per share. You sold a covered call at $136 per share. And then if Apple's stock were to go to $150, you would still sell the stock at $136, but you don't have to buy it at $150. So in reality, you're locking in your gain, which can help you to avoid being greedy, and you're receiving a premium to do it. So it's really like generating an income on a position you already own. The con in this situation is that you may be forced to sell your stock, which could trigger a short-term capital gain depending on your position, but again, you're locking in a gain, which is not the worst thing ever. The third way in which investors use options is to hedge or protect their investments. This would be buying a put on a position that you already own. This is really locking in or protecting your gain on a stock. Let's say you own Apple at $100 and you want to protect it at today's price, around $136. So you pay the $2.09. So in the event that Apple's price were to go down, let's say to $120, you would still sell the stock at $136. In the event that Apple stock were to go up to $140, you wouldn't have to sell the stock. You would just be out that $2.09 premium. So this is the best way to lock in a gain and still continue to hold the stock that you like. The pros here are that it provides a price floor for your investment, meaning that you have a set price and you can't sell lower than that. It's especially helpful after a big run up in a stock where you think that it's possible that the stock may come down in the short term. One of the cons of this that is important to know is that it could be quite costly to continuously protect your position. And in some situations, the premiums as a total percentage of the position can be quite high. The option becomes worthless at the expiration date, even if the stock price is just above the strike price. If you guys like this video and want more content similar to this, let me know in the comments below. Thank you for watching this video, and if you want to learn more about business and investing, comment, like, subscribe to my channel, and let's head on over to the next video.